I've always wondered, why are bank shares falling, not only in Kenya but worldwide? And so I researched, and I'm coming back to report uh, on the research that I did to get to understand why are shares in the banks falling. But before we look at why shares in the banks are falling, why bank shares are falling, I want us to quickly just have a look at how do banks make money, because understanding how banks makes money will enable us to understand why shares are falling. Now, it's paramount for you to understand that just like any other business, banks also make money. And with a banking business, just like any other business, it has got products and services that generate constant revenue. So I'm going to share with us five main ways on how banks generate revenue. And then from that angle, we shall go down and look at shares. So the very first major source of revenue for banks is, of course, you get it right, interest on loans. And this is the biggest source of income for any bank. Now, bank will lend money to individuals and businesses at a higher interest rate as compared to what they pay depositors. Example, if you if you deposit money, if you save money in a bank, and you might earn an interest of 5% or 6% per annum. The same bank will lend that same amount of money to someone else, a business or an individual, at an interest rate of around 13, 14, 15, up to 20%. This difference between the 5% and the 18% is called the interest spread. And this is where most banks make profit. Source of income number two for banks is fees and commissions. Banks charge fees for services like account maintenance, ATM withdrawals, bank transfers, and international payments. So anytime you are transacting in a bank, carrying out those transactions that I mentioned, they charge you a service fee, and by so doing, they make money. They also make money. They also earn commissions when selling insurance, investment products, or processing a payment for businesses. Source of income number three for banks is foreign exchange, also known as forex. The forex transactions. Banks make a lot of money by buying and selling foreign currencies at slightly different rates than individuals do. For example, when a Kenyan bank sends or receives money internationally, they earn from that exchange margin. When someone in Kenya, someone in the US or UK sends money, there's a transaction fee that the bank will charge you for receiving that amount of money. Source of income number four is investment in government, uh, treasury bills, and bonds. Just like individuals do, banks also invest heavily in treasury bills and treasury bonds. I've done a video on how to invest in treasury bills and treasury bonds, because bills and bonds are low risk and they are guaranteed by the government. So the banks don't have any risk when investing in treasury bills and treasury bonds. Now, these investments normally provide a steady interest income, especially during periods of high interest rates. Source of income number five for banks, this is corporate and SME services. Your salary is paid through a bank. So your employer has an MOU with the bank. And so anytime they process your salary, they deduct some money from each and every employee. So you can do the math. If a bank processes salaries for 1 million employees, and from each employee they just deduct you 100 shillings, that is 100 million shillings every month. So you can do that you can spread that one in 1 year, then spread that one to like 5 million employees, and then you see how much money the banks make from corporates. So beyond personal banking, banks earn from providing services to companies like loans for expansion, trade finance, payroll services processing, and advisory services. So these corporate clients normally pay large fees and generate big ticket interests for income for, for the banks. Now that you've looked at sources of income for the banks, I want us to look at why do bank shares rise? What is it that makes the shares to shoot, to rise? Shares will always rise or go up when, number one, the banks makes high profit from the sources that you have talked about. Banks report strong earnings, often driven by lending fees, interest income, and many other. So when they make higher interest, the shares also go up. Reason number two, why bank shares rise: attractive dividends. Kenyan banks are known for paying high interest, paying high dividends, which normally attract investors. So when more investors come, shares prices shoot. Reason number three, new products and services. Constantly, banks will innovate products and services like digital banking or regional expansion to boost investor confidence. Reason number four, economic growth. When the economy is booming, what normally happens, banks lend out more. And when they lend out more, it means that they earn more from the interest that they get from the money that's being lent out. So this normally skyrockets the profit, and this makes the shares to rise. Now we go to the core of this video. This video, why bank shares are falling, specifically in Kenya. Reason number one, and the most common reason, is the rise of mobile banking. This is M-Pesa, Airtel Money, and there might be many others. And let me explain. Today, in a single day, Safaricom's M-Pesa processes over 60 million transactions on a daily basis. Remember, each of these transactions has got a transaction fee. Now, this equates to roughly over 2 trillion Kenyan shillings per quarter. These transactions, the 60 million transactions on a daily basis, plus the interest that they accrue, were once done by banks, were once done through banks when M-Pesa was not yet developed or discovered. Currently, people pay bills, they transfer money, they save, they borrow, small loans, big loans through mobile platforms. Now, this portion eats into the bank's traditional revenue streams, like money transfer fees and small personal loans. Remember that initially, anytime you wanted to send money, you could go to a bank. Anytime you want to pay a bill, you could go to a bank, and they used to charge you the fees. But currently, all these transactions are done through M-Pesa. And by so doing, it means that it has eaten a big chunk, a very significant chunk of the amount of money that used to go to the banks. This is one reason why bank shares are falling. Reason number two, the emergence and growth of SACCOs. What do SACCOs do? SACCOs provide almost the same services as banks do: savings, salary processing, loans, and sometimes investment. But here is the caveat: loans from SACCOs are cheaper, services from SACCOs are easy to access, and they require less paperwork. Here is a statistic that will blow your mind. By 2024, in 2024, like the whole of 2024, by the end of the financial year 2024, SACCOs in Kenya had a deposit of over 1 trillion Kenyan shillings. This was competing one-on-one directly with the banks. What does this imply? This implies that the transactions and the services that were once being dominated and provided by banks, Equity, Cooperative Bank, and KCB, and many other, are now being served, are now being done or carried out by SACCOs. And similarly, this takes a big portion, a big chunk of what used to be to solely belong to the banks. Reason number three, high non-performing loans, known as NPL. Many borrowers, either individuals or businesses, have struggled with repayment. Now, if you don't pay your loan on time, if you don't constantly pay your loan on time, we call this an unperforming loan. In the Kenyan banking sector, for example, currently it has an NPL ratio, non-performing loan ratio of 15% in 2024. This is one of the highest in the East African countries. What does this do? When you don't pay your loan on time, that loan was already projected, the interest loan was projected by the bank. So when it becomes when it becomes non-performing, it shows that the profits that the bank would have made will no longer be made. And this subsequently reduces the income, reduces the profits that would have made by the bank, and this makes the shares to go down. Reason number 4, interest rate caps and regulations. Once in a while, you've seen the CBK, Central Bank of Kenya, of course, with instructions from the president or from above, where the rates change. So changes in rates, policies, and because all banks are regulated by Central Bank of Kenya. So whenever CBK introduces regulations or policies about the interest rates, this directly affects the bank, because if the bank was currently lending out at 20%, then a policy comes and it has to lend out at 15%, the margin, the 5%, will be a very big amount of money when it comes to loans. And subsequently, this will affect the amount of money that would have been the profit for the banks. So when lending rates are capped or restricted, banks earn less from loans. Reason number 5, competition from fintech and digital lenders. For the last 2, 3, 4 years, there have been a huge rise in digital fintechs and digital lending companies. And so this similarly, just like M-Pesa, initially when you wanted a loan, 5,000, 10,000, you would have gone to the bank. But right now, it's just a tap on your phone and then you get the money. So besides M-Pesa, fintechs and digital lenders are offering quick loans and payment services. This similarly slices away the market share from the banks, especially amongst the youth and the SMEs. Now that we have looked at why shares go down, the 5 reasons, I did a comparison between the bank shares versus other industries for the last 5 years. And I want to share with you these shocking statistics. So I did a sample of the last of 4 banks and 3 other industries. So Equity Bank in 2020, 5 years ago, a share was going at 50 shillings. 5 years down the line in 2025, the share is going at 57 shillings, almost stagnant. KCB Bank in 2020, the share was going at 45 shillings. In 2025, its share has almost halved to, it's actually less than half. It's currently trading between 21 and 23 Kenyan shillings, near half. Cooperative Bank, in 2020, the share was going at 13 shillings. In 2025, it's going at 11 shillings. Absa Bank, in 2020, the share was going at 11 shillings. In 2025, the share is going at 12 shillings. Almost a near flat performance. Now, let's dive into other industries. I did a research on just 3 other industries. And I'll start with BAT Kenya. BAT is a consumer industry. In 2020, a BAT share was going at 340 Kenyan shillings. In 2025, a BAT share is going at 420 shillings, almost double the price. Kenyan is an is the energy sector. In 2020, a Kenyan share was going at 5 shillings. In 2025, it's going at 8.8 to 9 Kenyan shillings. That's a 70% growth rate. Safaricom is a telco. In 2020, Safaricom share was trading at 28 Kenyan shillings. In 2025, it's trading at roughly 29 shillings. Despite dips, Safaricom has still dominated. These statistics, use them to do further research. Now, an Eagle's view. Banks' shares have largely stagnated or declined over the last 5 years, while other sectors like energy and other consumer goods have shown slight improvement, have shown resilience. Telcos like Safaricom, though pressured, they still remain dominant thanks to mobile money. In conclusion, bank shares are falling because the world around them has changed. Mobile money, like M-Pesa and Airtel money, SACCOs, fintechs, high non-performing loans, and regulations and policies by CBK have slowly eaten into the bank's dominance. What used to be a dominantly dominated sector by banks has now been encroached by other companies. But banks are still important for corporate lending, for large scale financing, and dividends. So, you as an investor, you need to balance. Don't write off banks completely yet, but diversify into growth industry. The moment, as as much as you want to invest into the banking sector, also look into consumer, look into manufacturing, look into retail industries, and do due diligence. A tip whenever you are investing, don't invest more than 20% of your investment portfolio into a single industry. Like, don't invest 20% of your portfolio into banking. Put some into banking, put some into manufacturing, put some into retail, and just diversify. And that is why bank shares have been falling. Let me hear your opinion on your observations. And until next time, I'll be seeing you in the next video. Bye bye for now.